This is Adam. He owns an apple orchard. He has a new business idea. Start the business of making apple jam or apple juice. Now, the future is risky. Now, Adam is confused. He doesn't know whether to start the apple jam business or the apple juice business. This is where Evie comes to his rescue. Now, who exactly is Evie? Evie is not a person, Evie is a concept. Let's get to know Evie better. The concept of Evie is adopted whenever there is a risk factor. And the risk factor, as far as Adam is concerned, is the labor market. The wages that he has to pay to the laborers may go up or down. It is highly unstable. So let's get to the details of each business. For apple jam business, the probability of getting cheap labor is 50%, wherein the profit is $10,000. Now, balance 50% is that of getting expensive labor, wherein the profit is just $3,000. Now coming to the apple juice business. The probability of getting cheap labor, we know it is 50%, and the resulting profit is $20,000. Balance 50% probability is of getting expensive labor, wherein he suffers a loss of $6,000. Which business should he choose? Here, EV or expected value can be used. First, let's take the case of the apple jam business. Suppose this apple jam business is continued for a period of 10 years. What is the profit that Adam gets? There is a 50% chance that he will get a profit of $10,000 and 50% chance that he gets a profit of $3,000. So out of the 10 years, 5 years he will get a profit of $10,000 and 5 years he'll get a profit of $3,000. So out of the total 10 years, 5 years he's getting a profit of $3,000 per year, and the balance 5 years he's getting $10,000 because the probability is 50-50. So what is the total profit? Total profit for 10 years comes to $65,000. Now let's take the average profit that he receives per annum. It is 65,000 divided by 10 years, which amounts to $6,500 per annum. This average profit is known as the EV or the expected value. So what is EV? EV is the average of the outcome if a decision was repeated many times. For our convenience, expected value is given by the formula EV is equal to sigma Px, where P is the probability and X is the outcome. And sigma, we know it means the sum. So let's use the formula and see whether we get the very same answer of $6,500. So EV is sigma Px. So let's take the first outcome. There is a 50% chance that he gets a profit of $10,000. So probability is 0.5 and the outcome is 10,000. So let's write that probability multiplied by outcome, that is 0.5 multiplied by 10,000. Now going to the next outcome. There is a 50% chance that he gets a profit of $3,000. Since it is sigma, we have to add that plus 0.5 into $3,000. So the expected value is equal to $6,500. So we get the very same answer. So henceforth, we will be adopting the formula for expected value, that is sigma Px. Now coming to the second business, the apple juice business. So here again, we will adopt the formula for EV, that is sigma Px. So the first outcome is 0.5 multiplied by $20,000 plus the second outcome is 0.5 multiplied by negative 6,000. So we get the EV as 10,000 minus 3,000, giving an amount of $7,000 per annum. So comparing the EV of both the business, the apple juice business is more profitable. So the final decision is start the apple juice business. So what was EV? EV or expected value is the average outcome if the decision is repeated many times, given by the formula sigma Px, where P is the probability and X is the outcome. So we come to an end of today's session. If you have benefited from the video, do click the subscribe and the like button, and do click the bell icon if you would like to see similar videos. So thank you all and meet you in the next video.